Hello, welcome to the Joe DeLisi Financial Advisor Podcast. I'm Joe DeLisi, and we're going to discuss Warren Buffett retiring today. Recording today on May 5th. You probably won't hear this until a week later. We have to get things through compliance, make sure what I say is not inaccurate. But this should be an easy one. Warren Buffett retired or announced his retirement at the end of this year. Hall of Famer investor. Everyone knows his name, Berkshire Hathaway. I wanted to take the opportunity, though, to just grab a couple of his quotes that I like, and some of them are recent, very recent, and use it as an opportunity just to go over why we build portfolios the way we do and why I help my clients walk through different market time periods the way that I do. As I put these together, I've got my notes here of these quotes. It really kind of hit me. And I said this, I think last year, or I said this at a different point where markets were really down. Honestly, very few clients of mine have quote unquote panicked. And it's just a wonderful feeling. I've spoken to a lot of you. I've emailed all of you, called some of you, spoken to some of you. Just not a lot of panic. I think you guys are very good at listening to how we construct portfolios, very coachable. You understand the methodology, but my job is to continue to explain it and to continue to teach it. So I love some of these Buffett quotes. I'm going to just in really no particular order. By the way, I grabbed all of these off of Yahoo Finance so that I could get the actual quote. So the first one, this is a very recent quote. And he says, quote, "What has happened in the last 30, 45, 100 days, whenever you want to pick, whatever this period has been, is really nothing." Buffett said this at the Berkshire Hathaway annual meeting on Saturday. Quote, "This has not been a dramatic bear market or anything of the sort." And he also noted that there have been 3 periods in history that have seen Berkshire stock fall 50%. And I went back and looked, and it's true. Now he rounded up a few times. I think like in 1974, it was down, 48%, but huge drops. Also huge gains. If you look year by year, just kind of comparing it to the S&P 500, especially in the earlier years. I think the data goes back to like 1965. From 65 through about 2000, I mean, he had some years where, and don't quote me on this. These are not direct figures. I'm just kind of paraphrasing, but he was up, 70% when the S&P was up 5 or maybe even down. So he had some amazing years, especially in the early goings. But his point is that to get that, really, he had to go through drops of 50%. And, our portfolios aren't really built that way. In 2008, as an example, an aggressive portfolio was down probably about 38%, somewhere in that ballpark. And it's because we build in high quality short-term fixed income. We build in non-correlated assets. So, you have a time period where every, sector is down, you're going to be down. But for the most part, you're not going to have these radical drops, 50% drops. We've seen it this year, where international is up relative to the US. And so that really mitigates any kind of scary type of a loss. But he went on to say, quote, "The most important quality for an investor is temperament, not intellectual." He also said, if you're going to do dumb things because a stock goes down, you shouldn't own a stock at all. And those are the quotes that I kind of pulled out. So the intellectual versus emotional thing is really, really interesting to me. One of the phrases we came up with in 2020 was "allow us to worry for you." Let me do the worrying. And what I really mean by that is that there's so much intellectually that goes on in building the portfolios that we use that it wouldn't even really do you that much good if you knew all the internal details of it. The high level is pretty easy to follow. We are building portfolios based off of certain factors that we can see in history where risk premiums pop up. It just simply means you're getting paid for risk you're willing to take. And some of them are really easy to explain. One factor, one risk premium is simply owning stocks over bonds. Most people understand that. It's pretty basic. If you own a company rather than a bond or a debt, you tend to be paid for that risk you're taking at a higher percentage over time. Not every year, but over time. Another factor we'll use, another risk premium that has shown itself to be pretty available in the past, is small companies over large companies. Again, a smaller company, if you think about it, a smaller company just simply will have more risk in it. It's just smaller. Another factor, another risk premium out there that we look at is we're going to look at value companies or distressed companies over growth companies. Now, those are the first three factors. And again, historically, the data is pretty, certain. And okay, we can see that. We can see stocks beat bonds over time. We can see small beats large over time. We can see value beats growth over time. What we don't know is when that's going to happen. And I think that's a great, throwback to the quote when Buffett was saying that, that he's had 3 periods of time where he's down 50%. This is arguably the greatest investor of our time. And yet even he can't predict the future. He doesn't know. If he knew ahead of time that his portfolio was going to be down 50%, maybe he'd go to cash and then rebuy back in. Maybe he'd time the market. But he doesn't do that because we can't predict the future, but we can build portfolios off of science and looking at data and saying, okay, although we can't predict when, we do know historically these things have occurred. Now, there are 2 other factors that are out there too, and these are, much more complicated to really get into the details on. For me, I'm a nerd and I love it, but another factor basically is just looking at profitability. Now, on its face, that seems obvious, right? A higher profitable company is going to be better than a lower profitable company, but really we have to figure out, well, how do we build that into the portfolio in terms of taking advantage of, for instance, a small distressed company? We need to look for profitability there too over non-profitable small distressed companies. So these factors have to be applied across the board. And another factor is momentum. So we really have 5 factors that we're looking at when we're building portfolios. And this will keep us away from speculating and gambling, timing markets, picking stocks. We don't need to do any of that. We just do it off of the science and the math. Now, that's all the intellectual. That's my job. But honestly, the bigger part of my job is to use the intellectual to be able to tell you, my client, we're not going to panic. And I'm not saying that just because it's easy to say. The reason we're not going to panic is I know exactly how we've built these portfolios. We've built them with science. We've built them with statistics. We've built them with data. We're not building them off of a feeling or a gut or because something is hot in the moment. And so again, in the time period that we're in right now, where we've got a Hall of Fame, arguably again the greatest investor of our time retiring and passing the torch. It's a beautiful thing to look at what that man has done without really timing markets and without gambling. He's not speculating with his clients' money, and neither are we. So I want to thank my small little part here. I want to thank Warren Buffett for everything he's done, for being the leader that he's been in the industry, and allowing us to look at somebody like him over many, many decades of having success and not chasing hot markets and showing us the way. And so that's it for today's podcast. Just a quick little, homage to Warren Buffett and a couple of those quotes that I really thought would be good in terms of reminding you about how we build portfolios.
Registered representative and financial advisor of Park Avenue Securities, LLC, PAS, OSJ 5280 Carroll Canyon Road, Suite 300, San Diego, CA, 92121 619 68464, Honduras. Securities products and advisory services offered through PAS, member FINRA, SIPC. Financial representative of the Guardian Life Insurance Company of America, are Guardian New York NY. PAS is a wholly owned subsidiary of Guardian. Westpac Wealth Partners, LLC is not an affiliate or subsidiary of PAS or Guardian. Insurance products offered through Westpac Wealth Partners and Insurance Services, LLC, a DBA of Westpac Wealth Partners, LLC, CA insurance license number 0D34103. This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by PAS, Guardian, or Westpac Wealth, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. Diversification does not guarantee profit or protect against market loss. Equities may decline in value due to both real and perceived general market, economic, and industry conditions. Investing in securities of smaller companies tends to be more volatile and less liquid than securities of larger companies. Investing in the bond market is subject to certain risks, including market, interest rate, issuer, credit, and inflation risk. Jan, sir, this material is intended for general use. By providing this content, Park Avenue Securities LLC and your financial representative are not undertaking to provide investment advice.